Good afternoon, everyone, and welcome to Abbott, Stringham, and Lynch's webinar series on the 2017 Tax Act. My name is Ramirez. I'll give you a brief introduction to who I am and the firm, and then we'll go over a few housekeeping rules and just so you understand how to download slides, and then we'll launch into our program. So I'm a partner with Abbott, Stringham, and Lynch. I've been here for about 7 years. Prior to that, I was with my own CPA firm, and prior to that was a Big Four accounting firm. So Abbott, Stringham, and Lynch is a 100-person local CPA firm, which makes us kind of unique in the Valley. It's a pretty large local CPA firm. I like that in that we're able to provide some local, the local delivery and personal services, but with 100 people, we have a pretty deep bench and expertise in different areas of tax law and accounting and auditing. And I think this webinar series is an example of that. I'll show you a list of the webinar series that we're about to undertake, but we do have at the firm, we have a niche group in construction real estate. We have a niche group that deals with technology and international companies, non-for-profits. We have a family wealth planning group that deals with high net worth individuals, as well as estate and gift. And all of these areas are impacted by the new Tax Act. So I think this is timely for our clients and our friends. We hope that you find this informative and that you'll use this information so when you meet with your advisor, you can have a background as to, what should I be doing for 2018? And not only 2018, actually, some of these provisions are relevant to 2017. And I'll point some of those out. And I think some of them are going to come as a surprise to you because they came as a surprise to us. And even now, 2-3 weeks into the new law, we're still without regulations. We're still without what they call the Blue Book. The Blue Book is something that Congress puts out that kind of explains the tax law and what the intent of the lawmakers was as they wrote the law. So we're eagerly awaiting that because there are areas in this law that are still unclear. And so we're kind of sorting through that, and we're hoping that we're informed so that when we meet with you and work with our clients, we can provide the best tax planning available. So for now, for those of you who are interested in slides and want to download those, I've already had that question, and if you go to the Q&A section, you'll see a link there. So the icons in the top right-hand corner of your screen, if you'll see that, you'll be able to click on that and download the slides. They're also in the chat box. If you look at the chat box, if you click on that, you'll see another link that also takes you to the slides. And that way you'll be able to follow along with me on the slides on screen and also on paper in case you want to make any notes. So I think before we launch into the my seminar, which is basically talking about just generally the major provisions of the law, I wanted to make sure you're aware of the individual webinar series that will be taking place between now and February. So on Thursday, we'll go, the 25th, we'll go a lot more in depth on what this law means for corporations and businesses. And then we'll, on Tuesday the 30th, we'll dive a little bit deeper into the individual tax rates and what that means for us from an individual position as well as estate and gift. And then probably the one that I think the area that's most complex of all, on Thursday, February 1st, we'll start talking about, what this means on the international side, because I think this is an area that probably where we had the biggest changes in tax law is on the international side. I'll touch on that today in today's seminar, but we'll launch a lot deeper on Thursday the 1st. And then for our real estate clients and some of our construction clients, I think Tuesday, February 6th is something you want to attend. That seminar can be dealing mostly with the impact of the law as it applies to our real estate clients and construction clients. And then last, on February 7th, and very timely for a lot of our clients, is what does this mean for pass-through entities? And I think it's a good time right now to define what a pass-through entity is. I think most of us know what that is, but just for sake of clarity, a pass-through entity is an entity, a business entity, where the income and the income tax flow through to the individual. So it passes through from the business entity to the individual. And that's going to be important because as you're going to see as we go through these tax rates, for our pass-through entity friends and clients, that tax that from the business income hits you at the individual level. So we'll see lower individual rates, but we're going to pay for that on the California side because we're going to lose our deduction. So I'll talk a little bit about that, but we'll go a lot more in depth on the 7th. So let's go to, oh, and one more thing on Q&A. Sarah just reminded me, who's sitting next to me on Q&A. If you have any questions, go ahead and put them down in the Q&A section. I'm going to wait till after the webinar and then take some of those. And if I can't get to some of those, if you've got your email address, we'll follow back up and do it that way. The intent of this particular webinar is to go about 45 minutes, leave a little bit of time at Q&A, and then be done somewhere around before 1 o'clock. So what is the 2017 Tax Act? Well, first of all, the actual name is an act to provide for reconciliation pursuant to Titles 2 and 5 of the concurrent resolution of the budget for fiscal 2018. So I think we'll just call it simply the 2007 Tax Act. And this particular act is probably the biggest change in law that we've had since 1986. And I will date myself a little bit. Back in, I started practicing in 1987, right after we made the last major overhaul to the tax code, the 1986 Tax Act. And I do recall at that time, and I was working at a big firm, we actually had a couple partners that retired. There were so many changes, they just didn't feel like keeping up. They were towards the end of their career, and they said, you know, that's enough. This thing is constantly changing, and this particular law is no exception. This is a time when we all have to get back in the books and study how this works and how that's going to impact how it's going to impact our clients, how it's going to impact your business. So we'll look at that, but this has some major sweeping changes. A lot of it very good. Part of what this act has been trying to do is to lower taxes. You saw that from the president, from our Republican Congress. What they wanted to do is provide for lower taxes to spur business, to spur the economy. And I think we're probably seeing some of that already, right? The market's been going great. It's taken off this year already. We just read articles about Apple getting ready to repatriate $245 billion of cash that is going to be reinvested in the U.S. through new headquarters, through new investments in manufacturing. I think the article I read said Apple was going to pay $38 billion in taxes. So maybe we're seeing some of the positive effects already from the change in the tax law. One thing I will tell you that it is projected to add $1.45 trillion to the federal deficit between now and the 2027 tax year. The government budget's on a 10-year window, and so they measure 10-year windows, and through the budget reconciliation process, anytime they decrease revenue, they have to increase revenue from other sources. So when you see the tax law, I've organized it in a way where you see where we're seeing the tax saver provisions or the tax reduction provisions. And on the flip side, they had to raise revenue from other sources. So there are provisions in there that are intended to raise taxes for some folks or take away certain deductions that are probably near and dear to us, especially for those of us who live in California. So the law generally is effective on January 1st, 2018, but as I'll point out briefly in the international area, you will see that that some of this applies in 2017, and you have to make some provisions immediately this year and figure out what that tax might be. So we'll see some of that. The individual changes, they all expire in 2025. So looking at all this, we'll learn all this, but it's all going to expire 2025. It reverts back to the way it was in 2017. So that's something to keep in consideration. Since we're talking about expiring and changing back, we might as well mention, if we have a change in president 2 years from now, 3 years from now, that could change everything we're talking about too. So keep that in mind as you're planning and making plans for 2018 and beyond. You know, how will the law change down the line? And if you make major changes, what impact of that is if the law reverts back to the way it was or changes completely? The other major provision is that, for the most part, the Republicans wanted to do away with the Affordable Care Act. That's what that ACA acronym stands for in that bullet point. Well, that did not happen. There wasn't enough political impetus to make that happen, so that the ACA stays, although a big part of it is that the mandatory health insurance, that got eliminated. So that was another thing. Another thing that, of course, we have to consider when we're doing planning is, what does California do with respect to all this? Well, as of right now, California hasn't conformed to anything. So we're making all these sweeping changes on the federal side, and then you still have to consider what the state ramifications are. So that's kind of a broad overview. I think you'll see a lot more in detail when you go to the specific webinar series, and they get a lot more in depth. Okay, so so let's dive into the individual side. I think probably the part that all of us really need to get familiar with is we have to get familiar with the tax brackets, because that's where some major changes have taken place. And so after this slide, I'm gonna dive into you're actually gonna see the tax brackets, and I'll talk a little bit about that. But I want you to kind of pay attention or note the tax brackets at the highest rate. You'll see that, so we used to have a 39.6 bracket at the higher end of the 2017 law. That has gone down to 37%, and I'll show you the detail there, but that's important to remember. So overall, the highest rate went from 39.6 down to 37. So a 2.6% difference. The brackets widen, and what I mean by that, when you widen a bracket, the amount that's subject to tax at a certain rate is expanded. So that gives you a tax break, because the tax brackets are widened a little bit, and you'll see that when I show the example. The standard deduction, so for those of us who don't itemize, you get a standard deduction. So it's $12,000. It used to be like $10,000, up to $24,000 for a married filing joint return. So that increases significantly. Now, most of us itemize because we have charitable contributions, we have mortgage interest, we have state income taxes, we have real estate taxes, maybe we have some expenses related to our investments. And if we had more of those than the standard deduction, we itemized. Well, as you're going to see, I think we're going to see a lot more taxpayers that aren't going to be able to itemize, and therefore the standard deduction becomes very important and relevant. Alternative minimum tax, or AMT. I think for a lot of you who are individuals, you're probably very familiar with AMT. Many of us probably paid AMT tax in 16 and before that because of our state income tax deductions, the preference items. Well, AMT was supposed to be eliminated. They kept the AMT system, but what they did is they significantly increased the allowance, the amount that you can exclude from income before you get subject to AMT. And they did away with some triggers that cause you to be AMT. So the AMT area got changed quite a bit. And it's more likely that we will not see AMT as much anymore under the new tax law. So let me show you the brackets, okay? And what you're looking at now is you're looking at a slide, and this slide is from a subscription we have called DNA, and you'll see the pre-reform law column there. Those are the tax brackets as they exist for 2017. Those are the brackets that we're dealing with when we file the 2017 returns. The brackets under the 2017 Reform Act, those are the brackets that are going to be applicable to the 2018 tax year. And again, I think if I point out, if you see that one that's labeled married filing jointly, you'll see that the 37% tax bracket kicks in for those married couples filing at over $600,000 of income. If you look to the left of that, you'll see that used to be $470,000 at 39.6. So that's what I mean by the brackets widening. So the brackets become wider and we lower the overall effective tax rate. So that's a good thing, right? We should be happy about that. Lower rates, wider brackets should be lower tax for individuals. And for the most part it is, with exceptions that I'll go into. I also list the married filing separate head of household. On the next page is the single brackets again. Now, here's an interesting point. Note that the 37% bracket kicks in for singles over 500. And that same 37% for married filing joint individuals was 600. So remember we used to have a marriage penalty? Well, it's back. Right? So now it's back. So if two single people can have $1 million of tax before they have to pay 37%, and that goes away. So now the marriage penalty is for married filing joint. We only get 600. Singles get 500. So, If you're single and thinking about getting married, you might want to wait an extra year to take advantage of that. That's just, don't want to have the tax tail wag the dog, but something to think about. You see the marriage penalty kicked in. I want to point out also that nothing changed with respect to the capital gain tax rates. They stay at 20%. Qualified dividend rates stay at 20%. So that does not change. What does change slightly, if I can point your direction to the married filing joint rates for under capital gain, you can see that that capital gains can actually be taxed at a lower rate than 20% if your income is below a certain level. So for those of us who have kids maybe, and they just started their careers and they need to lift up, and you think about making gifts, if you had any appreciated stock positions that you can gift them, and they're underneath these thresholds, they would, save you some money on the tax hit because they're being a lower rate than you would be. So something to consider, something to be cognizant of, that we do have lower rates for capital gains if you meet certain income threshold levels. Okay, so back to what I was talking about, how the law is organized in such a way that there's some provisions that are intended to decrease our taxes and some that increase. In this instance, I think I wanted to point out a few things that are very favorable to us as individual taxpayers. And again, there'll be a lot more detail on this and the separate webinar series. I just wanted to make sure that you were aware of them. One of them, and this is for those of us who have stock options, or if you're a business that issues stock options or restricted stock, there's some very favorable rules to those recipients of those options and restricted stock, in that they're now going to be able to defer income from taxation on the exercise of those options and that stock. So something you want to look at, if that's something that's of interest to you or your employees, if you're issuing options or stock, stay tuned for that. There's an election to defer for up to 5 years after meeting certain events that you can exclude the gain from income, at least defer it until sometime later. So something to hang on to. Luckily, that second bullet point, the House bill actually had the home sale gain rules going away. They were retained in the final version. So those of us who have a home and you sell it and you have under $500,000 worth of gain, if you're married filing jointly, you can exclude the gain on the sale of a personal residence. Those rules stay. So that's good news, because those were slated to go away. So we kept those rules. Another interesting provision that is worth noting is for those of us who provide 529 plans for our kids, our grandkids, those plans, we would fund them, and the proceeds of those plans, they could grow tax-free like an IRA or 401k plan. And if the proceeds from the 529 plan were used for college tuition, books, rent, and that, it was tax-free to the beneficiary, usually our kids or our grandkids. Now, the 529 plans, you're going to be able to use the proceeds for K through 12 tuition, private schools, religious schools. You can't do more than $10,000 a year, but that's a break. That's new. So that's something to take note of and consider for your kids or your grandkids. The other point under the individual tax law is now we are I don't know if most of you, if you're a high income taxpayer, and a lot of our clients are, they were not able to use 100% of the itemized deductions, because once you reached above about $130,000 in income, they started taking some of those away. So you wouldn't get the full benefit of your deductions. They were phased out. Well, that rule goes away. The phase out of itemized deduction goes away. Does it help us? Well, when I get to the next slide, we'll find out if it helps us or not. So what are the revenue raisers? So we talked about some of the items that it's going to probably save us tax or are positive to us as individuals. I think these are the ones that are going to hurt, especially for those of us who live in California, who have a home, pay high state income tax rates. And I think it's worth mentioning here right now what the tax rates in California are. For those of you who aren't clear, the highest tax rate in California, if you're making over $1 million plus in taxable income, is about 13%. There's, a 10%, after $1 million, you start hitting the 10% bracket and it keeps going up. And there's a mental health services tax that kicks in at 1%. So I've seen California tax rates as high as 13%. And so, and that's an important concept to remember. And I want you to remember that number that 13% number. And I want you to remember we talked a little while ago about the highest individual rate at 37%, because those are going to come into play when I get into the pass-through entity section, and probably developed a lot further when we have that second webinar down the line. So, so one of the biggest losers this time is we lose our state and local income taxes. They're now going to be limited to $10,000 a year. So if you're paying $50,000 in tax and $15,000 a year in property taxes, you're only going to be able to use $10,000 a year. For us, a lot of us, what we did a lot of planning last year, so we maximized that property tax deduction and we accelerated deduction. But in 2018, the cap is going to be $10,000. Now, I've been reading, and I know California, New York, New Jersey, some of these states that have high tax rates, they're revisiting this, and there's California is actually looking at, and I don't know if they're going to be able to pull this off, they're looking at changing the way we pay taxes so that part of it is a charitable contribution. I don't know if that's going to fly or not. I'm glad to see that they're trying to do something, but you know, $10,000 limitation is going to impact a lot of people, especially for those who are owners of pass-through companies and are paying tax at the highest rate. That's a big number if you can't deduct the state income tax. Remember what I said earlier, a pass-through entity, all the income and the tax is paid at the individual level. So if I'm an individual and I'm a member of a pass-through company, I'm an owner of a pass-through company, an S-corp or a partnership, and I'm paying tax at the 37% level because, you know, I have good years and I'm making more than $600,000, but I got to pay the same side on the California side, and I can't deduct the California tax except for $10,000. So that's an issue, and that's something that we're looking closely at. Mortgage debt. So as long as you had a mortgage that was existing on or before December 15th, you can keep up to $1 million of home acquisition debt. You're gonna lose your home equity debt. So a lot of my clients had $1 million of home acquisition debt plus $100,000 of home equity debt. We could deduct the interest 100% thereon. We're gonna lose $100,000 on any debt that's existing on or before December 15th. Any new acquisitions after that date, the number is capped at $750,000. So, and that's cut in half if you're filing separate. So that's something to consider. So that's a revenue raiser. Also going away under the new law is we're going to lose our deductions for the miscellaneous itemized deductions. You know, tax prep fees, your investment advisor fees, unreimbursed employee expenses, those sorts of things. That goes away. Most of my clients didn't usually get those because if they did, they were subject to AMT and we didn't get much of a benefit. So I don't see a big issue there. But maybe it becomes, and it even becomes less relevant because it's not even allowed anymore in 2018. One of the things that charitable contributions, actually we get to keep our charitable contributions and medical expenses. But interestingly enough, charitable contributions, the provisions are more favorable. It used to be you can only deduct 50% of charitable contributions of your AGI. So if your AGI was $500,000, you could take up to $250,000 of charitable contribution. That has moved up to 60%. So a more favorable charitable contribution rate, and we get to keep our medical expenses. We lose our deduction for moving expenses. So if you had employees that were moving and you were going to reimburse them for moving, part of that under the old law was excludable from income. That goes away. I think a really interesting provision is that second bullet point, and actually part of the House bill had this going away in 2017, which was a big deal. But now the final bill says that after 2018, any divorce agreement that calls for alimony is no longer going to be deductible by the payee, by the payor, and no longer includable in income by the payee. So I know I've been involved in a few divorce settlements, and part of the game is always trying to structure some of those payments as alimony because the payor could deduct the alimony from their personal tax returns. The payee had to pick it up as income. That is no longer going to apply in 2018, after 2018. So that'll be interesting to see how that plays out the rest of the year. The last point is IRA recharacterizations, kind of a little different kind of deduction. For people who roll their non-deductible IRAs into taxable IRA, we can roll them back and forth to get the optimum characterization. That goes away. So if you've done any of that or think about doing that, make sure you talk to your tax advisor before you do that in 2018. So just a few observations on my part on what I think this is all going to mean. I think the most important takeaway from the individual tax law, besides these little nuances and some really cool things on 529 plans and that kind of, is that the rates come down. Yes, they do, but we lose our state income tax deduction. So what does that mean for you personally? I think you have to model it to determine if you're going to pay the same. If not, my guess is, and I've done a little bit of modeling, it's going to probably cost us a little bit more in tax. That's kind of what I'm seeing. If all you are is a W-2 wage earner and you lose your state income tax deduction, if you're a high W-2 wage earner, my sense is you're going to probably pay a little bit more in tax. So that's something to keep an eye on. For simplification, so for my kids who have a little small W-2 and they don't itemize because they never had a house and property taxes, I think for them, this is simplification. It's a real simple return. Put my W-2 income, I get a $12,000 standard deduction or $24,000 if I'm married. Boom, there's my tax. I think that is simplification for those folks. For the rest of us, I think it just complicates things a little bit more. AMT, I think, is going to be almost irrelevant on a go-forward basis. So really, it's about learning where you're going to be in 2018 based on the new federal rates and the loss of our state income tax deduction. Okay, so what does the new Tax Act mean with respect to businesses? And major changes here. I think this is something that you're going to want to study a little bit more. If you have a C corporation, you're going to see some major changes in your tax rate next year, and we're already seeing that. We're already starting to see some of the impact of the reduced rates in next year. So that's something to keep in mind. I think you're going to see the rate goes from corporations pay a 34-35% tax rate in 2017, depending on your income. That rate's going to come down to 21%. So that's a 13 to 14% tax savings if you're a C corporation. Again, just a real quick definition thing here. C corporations are not pass-through entities. C corporations pay tax at the entity level, at the corporate level, okay? And pass-through entities do not. So if you're a C corporation, meaning you pay tax at the corporate level, your rate's going to go from 34-35% down to 21%, a significant reduction in tax. Another thing to take in consideration for C corporations, the C corporation California tax rate is 8.84. And if you recall what I said earlier, what is the individual tax rate at the higher end? It's 13%. The California tax rate, no matter at the high end, is 8.84. And that California tax is deductible for federal income tax purposes. So what it does, and I've done a little bit of math here, what it does is it drives your overall corporate rate down to between 26 and 27%, as opposed to 45, 47 if you're a pass-through entity. So we'll talk a little bit more about that. Just because you pay higher tax rates on a pass-through entity, there's still savings there when we talk about double tax. And I'll briefly mention that, but we'll go more in detail on that when we get into the corporate webinar series and the pass-through webinar series. But I think the takeaway from this is that one of the major tax reducers was to corporations. These are the big, the Apples of the world. I think Congress wanted to induce them to do more business here, stop their moving their resources and their intellectual property overseas and trying to take advantage of lower tax rate overseas. If by providing the competitive rate in the U.S., the theory is that they'll encourage more investment here in the U.S. So that's, a 14% drop in the corporate rate is significant. a complete repeal of the corporate alternative minimum tax. I didn't see a lot of that with my corporate clients, although it did come up on occasion, but that has been repealed for corporations. If you're a corporation and you have AMT credits, because you pay AMT in the past and you have them rolling forward to the 2018 tax year, those credits are going to be refundable. Actually refundable through cash from the government in the years between 2017 and 2022. So that's something to keep in mind if you're a corporation and you have AMT credits, is to make sure you identify what those credits are so you can provide for that and your refunds. I think this next bullet point is significant, and I know we're already starting to do some planning, and that's centered around the eligibility to use the cash method of accounting. So for those businesses that are required to use the accrual method, it's usually for one or two reasons, mostly because you have inventories or you exceed a certain revenue threshold. Well, under the new law, that threshold moves to $25 million. So if you have a business and your average gross receipts for the last 3 years are under $25 million, you're going to be eligible to use the cash method of accounting. And that could be a very big deal for businesses and pass-through entities if we're looking for tax savings. And generally, my position on the cash method of accounting is I love the cash method of accounting if you can use it for growing businesses. And the simple reason is if I'm a business and I'm growing, I can see myself going for the next 5 years, is that as my revenue goes up, presumably my accounts receivable will go up. And as long as my accounts receivable is going up, I should always pay less tax on the cash method than I do on the accrual method. Now there's exceptions and you have to kind of run some numbers, but generally speaking, in growing businesses, the cash method of accounting is preferable because you pay less tax on the cash basis. You can keep your accrual method so you can, for your balance sheet and for financial statement purposes to give to the banker or outside users, but the cash method for tax purposes usually results in lower tax for growing businesses. So with the expansion of that to 25 million, something you're going to want to make sure you explore. Section 179, for those of us who don't know what that is, essentially it's a section in the Internal Revenue Code that lets you deduct up to $1 million worth of new assets. The bonus depreciation, which I think is going to render 179 almost moot, we're not even going to need it anymore, is now you're going to be able to deduct 100% of your assets for any property that was acquired after September 27th with no cap. So if you put in $3 million worth of assets that qualify, you can expense $3 million. So, and that's new or used property. So that's very favorable provision, very favorable business provision. Something you want to, if you have plans to grow, that is something you're definitely going to want to model for tax purposes. So flip side, what provisions are there in business that kind of maybe cost some of our clients and our friends? Well, and beginning in 2022, and this is beyond our radar right now, but trust me, it's going to get a lot more attention down the line. We have a lot of technology companies that spend a lot of money in research and development. And beginning in 2022, those research and development costs are going to have to be capitalized and amortized over a 5-year period. So that's significant. Maybe the game is that maybe they're not R&D for the purposes of what we're calling R&D, and so that's something that we definitely have to look at. For those clients that were in the manufacturing business, construction business, you probably took advantage of what we call the domestic production activity deduction. That goes away. So that's gone. Another big area that's going to impact a lot of our real estate clients is like-kind exchanges only apply to real estate. No longer do they apply for personal property. And I'll elaborate that on just briefly when I get to the observations. For a lot of us who do a lot of entertaining and taking clients out to meals and ball games, the government is starting to put some restrictions on that. You're going to want to make sure you look at those rules. Another big factor is for those of our clients and businesses that are highly leveraged, you're going to that deduction for interest expense is going to be limited. It's 30% of your EBITDA, and that number changes after a few years. So if you've got a lot of interest expense in your company, a lot of private equity firms leverage a lot of their transactions, those deductions could be limited in 2018. You're going to want to look at that. Net operating losses. So real quickly, if you have a net operating loss, if you don't use it up that year, you can carry it under existing law. You can carry it back 2 years and go get refunds, or carry it forward for 20 years. And so that was so now the new law eliminates the carryback period. We can no longer, in 2018, can no longer carry back net operating losses. They can only be carried forward indefinitely. There's no longer any more 20-year time frame. They now can be carried forward indefinitely, but we can only use 80% of that net operating loss. So if you've got a net operating loss going in 2017 and you can't carry it back, and you're expecting not to pay any tax because that loss is big enough to absorb what you expect your income to be in 2018, that is not going to apply. You're going to be limited to 80%, and you have to pay tax. Okay? And that last bullet point, I just threw in as a zinger because the environment that we're in, you know, all these sexual allegations. Well, from now on, if you have a sexual harassment suit and settlement, you're no longer going to be able to deduct it. So I guess that was Congress's response to some of the environment that we're in. So I thought I threw that in there for information purposes. So what are, you know, just general observations? I think the cash method of accounting for a lot of our clients is going to be relevant. That is something we're definitely going to be looking at. Change accounting methods in 2018. Reduce our tax. That's something that again, if you're under 25 million and you're eligible, something to talk about with your tax advisor. The reduced tax rate for corporations versus pass-through companies is a big deal in my mind. And this is me speaking. I think it's worth visiting, running some calculations, analyzing where you stand from a profit standpoint, what you would be paying tax as a pass-through entity, what your tax would be paying, what tax would you be paying as a C corporation, comparing the two, and then having to consider the potential double tax if you were forced into an asset sale down the line. If that's kind of a little bit too much, you know, what is an asset sale? How does double tax work? Let me just say that if you tune into our corporate series, I think that'll be expanded a little bit more. But essentially, the reason why most companies organize as a pass-through entity, again, S corporation, partnership, LLC, is because they don't want to pay double tax. If they end up selling the company down the line and they sold assets, the tax would be taxed. The tax on the income would be taxed only one time at the individual level. So that's why most of us switch to a pass-through entity. But with this now, it could be anywhere between 13 and 17% difference in tax rate. It's something to think over again and see if it makes sense. Expansion of, you know, bonus depreciation. I think that's something that is relevant, especially if you're growing and you're planning on adding more equipment. If you're a real estate company and you're buying more real estate and you're doing cost segregation studies, allocating some of that income to property that's shorter lived, that qualifies for the expensing provisions, makes a lot of sense. One caveat I'll put there, then something I want you to remember. Remember when I said back a little while ago that like-kind exchanges are limited to real estate only? If you do a lot of cost seg work and you have a lot of personal property and you want to exchange that building 10 years down the line for another building, you're going to have to make some calculations and amends for what we did on the portion that was allocated to personal property, because that part is not going to be eligible for the like-kind exchange rules. Okay? So something, again, to think about, talk about with your advisor. Okay, so pass-through entities. As I mentioned earlier, pass-through entities are S corporations, LLCs, partnerships, single-member LLCs, anything that where the income and the tax flows through to the individual level and it's paid at the individual level. So what the Act does, it puts in some new rules aimed at providing greater parity between the tax treatment of pass-through entities and regular corporations. As long as I've been practicing, I've always thought it was unfair that my clients that owned, you know, relatively small business compared to the Apples of the world, that owned S corps and LLCs and were S corps and LLCs for very valid reasons, I always thought it was unfair that they had to pay tax at the highest individual rates, 39.6 and 13, when their corporate counterparts pay tax at a lot lower rate. I just felt it was the smaller business person was at a disadvantage. Well, I think this is the first law in my 30 years of practice I've seen finally try to put some parity back into it. So essentially what it does, and again, I'm not going to go into great detail here because there's a lot of technicalities and definitional things that you have to understand how it works, but essentially if you're an owner of a pass-through entity and you have qualified business income, and basically it just basically active trader business, real estate counts, by the way, if you have qualified business income, you're able to deduct 20% of the taxable income and take it as a deduction against your federal income tax. So if I took 37%, which is the highest individual rate, and I multiplied that by 20%, which is the deduction I'm going to get for the income that I'm claiming from my pass-through entity, it drives your federal rate down to about 29.6. So what it does, it drives your federal rate from 37 down to 30 if you have qualified business income and you qualify. It's not 21% like the C Corp rate, hey, but 30% is a lot less than 37. So there's the parity, and it's the closest I've ever seen it in the 30 years I've been doing this. So 37 versus 30 if you have qualified business income. Now I will tell you there's limitations based on W-2 wages that you pay, and for our real estate clients based on the gross assets on your balance sheet. We'll get more into that detail when you get into the pass-through entity webinar series, but something to think about if you're an owner of a pass-through entity and you're profitable and you're making money and it's active trader business, there's a 20% deduction in 2018 from your federal income tax that's going to drive your rate down to 30%. Back to my point earlier though, if you can't deduct state income taxes and you're paying tax at the highest rate, $1 million plus in income, you're probably at the 40 to 43% tax rate. Still better than probably where you were in 2017 if you have this, but still a pretty high rate that you're paying, but less than 2017. So overall, positive. This QBI thing I think is fantastic. There's some complications here you need to really look at and understand. Service businesses like our firm, accounting firms, law firms, doctors, if we're a service business, we're not eligible for this, subject to some income limitations for this reduced rate. So for those of us who are in the service business, and there are definitions of what a specified service business is, I can tell you that architects and engineers escape the definition of a service business. So if you're an architect or an engineering firm, you're going to qualify for this 20% deduction. For the rest of us service-related businesses, we don't qualify, and we're looking at some pretty high tax rates. So something to stay tuned for, understand, and see how that it's going to impact you and your company. So the revenue raisers on the pass-through side is, again, I think the first bullet point is kind of a little political football for the VCs out there, and they took a carried interest in businesses that they started. In order for you to get capital gains treatment, you have to hold that interest for 3 years as opposed to 1 year to qualify for the lower rate. That second bullet point is something that snuck up on some of us and something that takes a little bit of study. If you're a business owner and you have multiple passive entities, you might have an interest in an S corporation, but you've invested in 2 or 3 real estate partnerships, and you've got another business over here. So you've got multiple passive income, and maybe one of them had a big deduction and it offset the other income. That deduction is going to be limited to $500,000. And that, it may seem like a lot, but I have clients who you know, there's some big losses in some of those companies, and we can take those losses. That is now going to be restricted to $500,000 a year from all of your passive entities. So for me, for us as a firm, and we're doing your taxes, if there's interest that you own in these other business, and we're not in these other businesses, pass-throughs, and we don't know what the income or loss net is, we could be surprised. So there's a conversation that has to take place so we know exactly what is your overall income and loss from the pass-through so we can apply this limitation. So a little complication that we have to be careful. So my observations is that I'm a big fan of the 20% reduction. For the first time ever, we get parity between the big companies and our pass-through clients. It's not going to apply to everybody. If you're a specified service business, you need to understand what that means, see if you're exempt from that. And I think it's worthwhile to evaluate, you know, what your overall tax rate is versus, you know, a regular corporate rate. Okay. I think one of the biggest, probably the most far-reaching impact of this new tax act is in the international area. And I'm very grateful for the people we have at our firm, you know, the international side headed up by Mike McAndrews, and we have some good senior managers in Jyoti Chalara, and we have, you know, Erica Diver. We have some good people in our international group, and it's growing, good staff, and we're spending a lot of time right now in the last few weeks studying on this, and we're in the process of trying to put some checklists together and templates together to see how this is all going to work, because as I mentioned earlier, we still don't have regulations on how we're supposed to apply the law. We still don't have a blue book explanation on what Congress intended, because there's a lot of this is definitional. There's so many new definitions in the international area. I'm not even going to go into the detail of what they're called, but lots of new definition, new terms of art that we need to understand and see what they mean. The positive side of all this is that on a go-forward basis, beginning in 2018 and forward, if you're a corporation or an S corp, any kind of entity that owns foreign corporations, and that foreign corporation declares a dividend, that dividend is going to come back income tax free. Okay. Now it's still subject to all the local tax rules and all maybe any withholding tax at the country source level. But if you declare a dividend after 2018 on any of the earnings of your foreign corporations, there's definitions on what that is, what a foreign corporation is. But if you declare a dividend from the profits on your foreign corporations, they come to the U.S., they're going to come back U.S. income tax free for federal purposes, not California, for federal purposes. Again, you might have to pay a withholding tax at the foreign country level, but in the U.S., that's going to be taxed. And you will not be able to use any foreign tax credits on that income that you declare and bring back after 2018. So something to take in consideration, something you probably should model and figure out, you know, what that's going to look like in 2018. Positive, again, positive for our clients, this new term, foreign-derived intangible income deduction. Essentially what that is, it's a complicated formula, and I'm just giving you the highlight here, but basically what that is that if you have income, and I don't like the name intangible income, but because it applies to services. If you have any income from IP or services that are being used in a foreign country, so the ultimate user is somebody in a foreign country, Canada, Mexico, Europe, wherever, and you have income from that source of income, you can take a 37.5% tax deduction on that foreign source income. So something that needs to be evaluated and analyzed on a go-forward basis beginning in 2018. This next piece, the revenue raisers, this first bullet point, the repatriation tax, that's the one that probably has the most concern. That's the one we're spending a lot of time on and focusing on, because that tax is due in 2017. I think there's an error on my slide. It says beginning 2018. It's wrong. It's beginning 2017, so it applies. We have to calculate that tax, and that first payment is due with your 2017 income tax return. So basically what it is this. If you're a corporation and you own a controlled foreign corporation, if you've owned it in the past, you have to go out and make a calculation of all the earning profits of that corporation from 1986 to December 31st, 2017. So if you've had that controlled foreign corporation for 20, 30 years, you have to make a calculation of what its total earnings and profits are to December 31st, 2017. Then you got to figure out of all earnings and profits, if you have any. If you're all in losses, this becomes irrelevant. But if you have profits overseas, then you have to figure out, well, of all my profits, are those profits sitting in cash? Are they sitting in assets? And then you have to do some calculation to figure out what that looks like. And then once you know what that amount, you apply two different tax rates, either a 15% tax rate or an 8% tax rate on those earnings and profits. And you pay that either all in 17, or you can make an election to defer it and pay it out over 8 years. So that's the part that right now we're trying to figure out, okay, we have lots of clients that have foreign corporations. We don't do in-depth earnings and profits calculations on an annual basis. First of all, they don't want to pay us to do that. It takes more time. There's a little bit of work involved. So, but now we got to go back under this new law, go back to the very first year of that company's existence, if it was happened after 1986. Calculate on a year-by-year basis what the total earnings and profits are to December 31st. Figure out how much applies to cash, non-cash, and then figure out how we're going to pay that tax. And that starts in 2017. So if you have that, make sure you reach out to your tax advisor. We need to kind of get a handle on that. The other, this last provision under the new foreign rules, we call it the GILTI tax. I think it's kind of the new AMT tax. Only applies to corporations with companies that have foreign operations. So if you're a U.S. company and you don't have any foreign corporations, you don't have to worry about any of this stuff. But if you do, and you have some foreign corporations in 2018 and move forward, if you've got any income that's taxed at a rate at about 13% or less, you're going to be subject to this new GILTI tax. And it's a complicated formula. And it can actually be more than 13% because there's some cost allocation you're supposed to apply. But in my mind, I'm kind of looking at it as it's the new corporate AMT for companies that have foreign operations. So 4 major provisions in the international area, all of them complex, none of them easy. They're all going to have to take some time to kind of go through that. We don't have any regs yet. One of the things that we're thinking about here at the firm is maybe we extend all of our corporate clients with foreign earnings just so we make sure we have a very good handle, and wait to see until we get more definitive guidance. And that's something we're thinking about, but significant changes in the international arena. So I think that's kind of self-explanatory there. What I'm going to do now is just real briefly, I didn't put a lot in the estate and gift area, but I think this is going to be covered by I think Julie Malakadayat, one of our partners in the Family Wealth Planning Group, is going to be doing the individual tax webinar. I think she's going to go into what the implications are under this new tax under these provisions, and I'll just leave it at it got doubled. Our exclusion, the amount that we can pass to our heirs tax-free, is doubled. So if you've already done a lot of estate planning and you've maximized the use of gifts and exclusion, this is your chance to do some more, because as I mentioned earlier, if the law is changed and you'll lose, if you don't take advantage of this, you're just going to lose it. It'll go back to some new number, but they can't take away what you've already done. So in my mind, you need to reevaluate your existing plan and do some planning. So Sarah, I think I'm done. I don't know if we have any time for some questions. We probably, I do have a few questions here. So let's see. Bear with us while we try to kind of. So when somebody asked, okay, so my home equity line of credit, is it okay in 2018? And my response to that would be, if your HELOC, if it existed before December 15th, it's no longer going to be, it's no longer relevant in 2018. So it no longer is going to apply into, now, what you did with the proceeds of the HELOC could be different. If you use that HELOC to add an addition to your house and it's still under the $1 million, then it's still relevant. So it really depends on what you did with that home equity line of credit. Does a 100% bonus apply to buildings acquired by corporations? Yes. So if a corporation goes out and buys a building, and that building, you did a cost segregation study, and you were able to segregate the cost of that building from real estate to property that qualifies for the bonus, you do get the bonus depreciation, and that's a big benefit. I have another question here is, does it make sense to stay an S corporation? I don't know. That's an answer that really needs to, you need to do some analysis. A lot of moving parts. Again, as I said earlier at the very beginning of our webinar, there's midterm elections coming up in this year, I believe, 2018. Is that right, Sarah? Sarah says yes. So 2018, we're going to have some midterm elections. We have a new presidential election 3 years from now. Who knows what's going to happen? Who knows what happens with tax rate? I can tell you it's a monumental task to make major provisions to tax law, as evidenced by what we saw here. I haven't seen a tax law this widespread since 1986. So this kind of change doesn't happen automatically. It takes extraordinary circumstances. Will we see any major changes? Probably not. Minor changes? Probably. So yes. So the question is, do all these apply to 2017 or 18? As I mentioned earlier, most of the provisions apply to 2018. Some apply in 2017, especially on the international tax side. So if you've got some companies with international entities, make sure that you've addressed those issues and see how it's going to impact you. So I think I got to most of those. Thank you for your time. I hope this was something of value to you. I really hope you tune in to the rest of our webinars where we will provide you more detail. Have a great day, everyone. Bye-bye.